If you don't buy a house before the end of the year, you could die. Does that sound like a pretty dramatic headline? Well, it is a little bit exaggerated, but let's take a look at what we mean by the risk of going past the end of this year without buying a house if you're currently renting. Anybody here remembers the housing bubble of the 2000s, remember the rallying cry, buy now or be priced out forever. And it turns out that that was actually not true. People who did buy then actually were not priced out forever. Prices went down temporarily, and it was a little bit more of the fear of missing out kicking in to have people buy homes that they couldn't afford. But what's different about 2022? Buying a house now, while it's still possible, is not just about having a place to live. It's about the future 10, 15, 20 years from now of literal survivability. What do we mean by that? Well, here's an excellent article in Jacob and Mag where they talk about how homeownership going forward has morphed not just to have a roof over your head, but also a combination of retirement plan, social justice, and financial security. And the reason that homeownership has been promoted by governments is because Social Security, pensions have all been gutted, and there's really no financial underpinnings to keep people out of poverty in retirement. In fact, that's been a newsworthy article. America's homeless. People that are retired, graying, retire on the streets. And we'll look at that in the later parts of this video. But more to the point, unbeknownst to a lot of people, and even an invisible factor is, governments have been happy to let the home function not just a place to live, but as a retirement plan, an alternative to a precarious and predatory rental market, and a simulation of the consumer wealth effect. So homeowners, the government doesn't have to worry about homeowners having retirement problems, having social security deficiencies in the future. They have a home, they have a place to live. If you bought a home anytime before you're 50 or 60, you're probably going to have a secure place to live with a fixed payment in your retirement years. Farther along in the article, it says, solving the present crisis is how head-spinningly connected everything is. Retirement, homeownership, Social Security, social justice. And it's difficult to enact reforms because it also affects negatively some of the other factors. The punchline of this article is the housing crisis is a problem that will not stop. And it's only a crisis for those who don't have a house. It's like a big game of musical chairs. There's not enough chairs to go around, in this case houses. Then there are people who want to live in a house. A lot of people are renting, whether it's a single family home or an apartment. And soaring home prices and rents are starting now to expose the defects in the story of homeownership. It's very likely that the homeownership possibility for a large percentage of the population is going to get even more difficult. Not only because of the market, because some social programs and government intentions may de-intensify or deprioritize homeownership as a means of residence. Last quote from this article, and we'll move on to some math, doing numbers on how homeownership might be a matter of life and death. Home ownership is now considered a cornerstone middle-class good enjoyed by roughly 2/3 of the population. So that means a third, 30%, are not homeowners. What's going to happen to them? Well, let's do the math and see what homeownership is today and what it could be very, very soon in terms of numbers. This is a chart of median sales prices of homes. As you see, it's gone up dramatically, especially this spike here from 2019. But in reality, if you look at the trend from here in 2012 to 2017, this rate of growth, if projected, would end up at the same place. This is a straight line, right? There was a little bit of a downturn in 18 and 19 in median homes, but if you drew an extrapolated line from even right here in 2012 to 2017 and drew a straight line, it would still meet where we are now. About $410,000 median home price. In fact, if you drew a straight line from before the housing crash, going back 5 years, from 2001 to 2007, this straight line would still meet where we are today. It was just this drop when the housing crash happened, which was a transitory event. It was because of lending practices, not necessarily because homes were overvalued. It was just a temporary blip where people who purchased homes at the correct values were not able to keep them because they were not financially able to maintain the payments. That's not the case today. Everybody who bought a home, even before the housing bubble, 2003, 4, 5, 6, they all believed that the price they were paying was worth it to have a roof over their head. Everybody today believes the same thing. The difference is people who are buying today are at very little risk of losing the home because of non-payment, because of the severe underwriting requirements for mortgages. In fact, throughout the history, go back to the 1960s, there was never a severe foreclosure crisis that occurred other than in that short period of time. And it's because there was some very specific lending laws and looser guidelines that were put in place in the late 90s that allowed anybody to buy a home without regard to income, credit, down payment. And so it put a little blip in the market for a short period of time. But if you see this trend, if it were not for that blip and it still followed this same trend, we'd still be at the same place we are today in terms of price. So it's really not overvalued. It's the right value of what it would have been with the same rate of growth. So what does that mean for a mortgage? $411,000. Here we have a sample mortgage payment. A $411,000 house gives you a mortgage payment of about $2,000. Now, that includes principal and interest, insurance, and estimated taxes. It's very likely that an actual payment will be a little higher than this because taxes are going to be more in most places than $3,000 a year. Insurance here is figured at about $800 a year or $66 a month. Most places in the country, your homeowner's insurance will be a little higher. But this also includes a 20% down payment, which is $82,000. In the median price or median income, it's likely that some people would have $82,000 down payment. But if you exclude prior homeowners that have accumulated $82,000 in equity, how many of that 1/3 of current renters have saved up $82,000? It's probably a much lower percentage because they're renting, they don't have the equity accumulation, and their rent payment burden on their income is probably pretty high. They're probably not saved up. Even if somebody saved up $8,000 a year, that would be about $700 a month. That would take 10 years to save up $80,000. It's a pretty significant amount. Saving $700 a month after taxes for somebody who's renting probably is a rare event. So let's take a look at what this means in terms of home affordability right now versus maybe even by the end of the year, how it might be a permanent exclusion of future home ownership. We've now adjusted the home price to a little over $500, and we've adjusted the rate to 6.5. And look at your payment now. Now your payment is about $3,000. It went from $2,000 to $3,000. Now, again, this assumes pretty low homeowners insurance and property tax. In fact, if you buy a house for $500,000, your taxes are probably going to be much higher because it's based on the home value. So will insurance. But let's just use these numbers for the time being. It also increases the down payment from $80-something thousand to $100,000. That may put many current renters completely out of the ballgame for coming up with six figures for a down payment. Are there ways to maybe put less down, maybe 10%? Probably. But we'll talk about that a little bit later as well. What does that mean to have a $3,000 payment in terms of being able to get into a house? Well, $3,000 in after-tax money every month means about $5,000 in gross income. $5,000 in gross income is about 60 grand a year. Now, if you want to spend no more than half of your income on your home cost, mortgage, rent, whatever it is, in order to take home $3,000, you would have to make $120,000 a year to take home enough money to where this $2,944 is half of your income. It's highly discouraged to spend half of your income or more on your housing cost. So if the home prices go up to 503 and the rates go up to 6.5 by the end of this year, it would take $120,000 income to be able to comfortably afford a house. That's going to put a huge percentage of the population out of contention. How come? Well, here is the median household income. Right now it's roughly $70,000. So to go to 120, it would be about 50% higher than the median income. And that median income has gone up in the last few years. A little bit of a drop in 20 because of some things with news events that have happened in the last couple years. But in order to buy a median house with a comfortable income burden payment, you need to make $120,000 a year. Now, why did we use a value of 503 instead of 411 or 415, what it is now? Well, home prices went up last year 19% year over year. Some people think that the rate of increase has stopped. There's many reasons why it's likely that 2022 will have exactly the same rate of price increase as 2021. If the $411,000 house goes up 20% in value, that's about 503. And the rate currently is at 4.8, 4.9, just shy of 5, is likely to go up a percentage point at least within the next year. The Federal Reserve has indicated wanting to jump up the rate to try to stave off inflation and maybe cool the housing market. In fact, rising interest rates will make home prices go up, not down. And the reason why is because what we talked about in a prior video, where homes are like musical chairs. If you're in a home right now with a 2 or 2.2% mortgage, even if you find a better house and use your equity from your current house to upgrade, you actually have to find a house that's $120,000 to $140,000 better just to keep the same payment, because your interest rate on your new loan is now going to be 6% or 5.5%. Going from 2 to 5.5, nobody's going to do that. It's going to keep more people in their houses from selling them, and there'll be even less inventory in the marketplace. So if, these are big ifs, but assuming that home prices go from 411 to 503 and rates go from 4.8 to 6.5, you now go from $2,000 a month, which many people can afford. That's about what a lot of people pay in rent, to $3,000 a month, 50% increase. That puts it out of reach for a large percentage of people who are currently renting. Somebody who's currently renting probably has a rent payment that's close to $2,000, maybe $1,500, $1,600, somewhere in that range. So their payment going up $400 or $500 to own a home is probably something a lot of people could stretch and make happen. That's assuming you can come up with a down payment. We'll talk about that in a moment. But going from $1,400 or $1,500 to $3,000 to own a home and having to come up with $100,000 out of pocket, that might be the deal breaker for a lot of people. Well, if you miss out on that opportunity to not buy a home right now, where could that put you in 10 or 15 years or 20? Well, if you can't afford a house now at $3,000 a month with $100,000 down, in the future when prices are higher, you won't be able to afford it then either. Your income's not going to go up fast enough to make up the difference. So, according to the Atlantic, life without retirement savings, what does it look like? Seniors are stuck with lives of never-ending work, a fate that could befall millions in the coming decades. Without a home that you own, your rent will constantly accelerate and increase. $1,400 this year, $1,600 next year. In 5 years, it's over $2,000. In 7 years, you could be paying this $3,000 anyways on rent and not have any equity. So that is how that fate could befall millions in the coming decades. And we've seen a lot of stories. There's an example of somebody, the woman that's 76. She didn't think she'd still be working. She goes down to the grocery store and hands out samples, earning $50 a day because she needs the money. Most people who are in their 70s don't want to be working, don't want to be at the mercy of a landlord. And sure, there's Social Security for low income, but it's not enough to afford currently the basic necessities, even before the inflation kicked in, and in the future, prices will be even higher. Most people don't have a lot of money in 401k plans. The government has kind of shifted the burden of retirement funding from Social Security to 401k plans. That's why they came out with 401k many years ago, to incentivize people to put their own money in, because the government can't afford it with Social Security. But most people have maybe $15,000 in a 401k, according to the article. That's not enough to retire on. That might not even last 1 or 2 months of expenses. The director of the National Institute on Retirement Security said there's a lot of people who have downward mobility as they get older. They're going from being near poor to poor. Owning a home might be the only method to prevent that from happening. Because if you take out a mortgage that's a 20 or 25 or 30-year mortgage, no matter what age you are today, in that 20 or 25 or 30 years, you will instantly have 0 monthly payments for your housing. This can help prevent you from retiring on the street as an older person. This example came from a person in Phoenix where the median rent was $1,200 for a 1-bedroom. And there's a huge boom of senior homelessness. There are people pushed into the streets by rising rents, according to this article. This person was an example of it. People 50 and older suddenly without a permanent home after job loss, family death, or health crisis. Well, if you own a home, you can't be suddenly without a permanent home, because you're going to pay rent for your residence or pay a monthly fee for some period of time going forward. If you are currently renting and you're in your 30s, 40s, or even 50s, you're going to be paying a monthly payment for the next 20 or 30 years regardless, because currently you don't own a home. If you buy a home today, you're going to pay still a monthly payment for the next 20 or 30 years. But at the end of that time, when your mortgage is paid off to 0, you instantly have no monthly payment. So no matter what happens, lose your job, get sick, have some financial problem, you now are not at risk of that roof over your head being taken away from you. The home is yours. Yeah, you have to pay taxes, and that might be a few $100s a month. You may have to pay insurance that could be a few $100s a month. But if you have a home, you also have a potential source of income. If there was an emergency, you could rent out a room to a roommate and have that cover some of your expenses. That window of opportunity for owning a home may be closing quickly because of this. Because of if this home rate increase goes up another 15 to 20% this year and makes this math impossible to catch, it can shut out many, many people from home ownership. And back to this study about what home ownership does besides put a roof over your head. The market is the arbiter of wealth of the homeowning class, meaning that if you own a home, even your primary residence, you have stability and prosperity because of that market. A renter does not have that stability and prosperity. Now, I understand it's easy to say just go buy a house. It's harder than that. It's more complicated than that. You may not have the money for the down payment. You may not have the credit. But there are ways to try to overcome those two obstacles. It may not be possible. If it's not possible, then owning a home isn't going to happen anyways. But if the only reason that you're not pursuing a home purchase is because of fear of the market or decision on affordability, fast forward the tape of the potential movie of life by 10 or 15 or 20 years and see what that affordability is going to look like. Heck, even go back 2 years or 3 years. If you were hesitant to get in the market in 2019 or 20 because you wanted to wait for the market to cool down or be able to afford it, think about what's happened since then and what it would be like to go back in time that far. So let's go back to that 411 house, or that's close enough, 409 at 4.8%. Needs about $80,000 down payment. What if instead of buying the median house, you really became disciplined and bought a house that was kind of beneath what you thought your life was? And you've seen it on our website, Homes Cheap, about those options. Let's slide this back to maybe just under 300. And we talk about houses all the time that are in the 200 range, but let's even go up to 298. And let's say instead of 10%, you find a mortgage program that will do 10%. Okay? Now, you're going to need $30,000, but your payment is now $1,600. This may be a way to lock yourself in to the market at a payment that's your current rent. Now, a 298 house in this market is probably not going to be that nice. I was just watching some reruns of one of those home choice shows where they take shoppers around to a market and show them 3 or 4 houses, and they pick out one that they like in a different area, and it's kind of like a home shopping type reality show. And this show was filmed in 2014 and 15, and they were showing some great houses for around 300. Sometimes the person would say, my budget's 300, no more than 325, and they were thinking that's a lot of money. And there were some nice houses. Nowadays, it's tough to find a really nice house for 3 or even 350. It's hard to find. Those houses are in high demand because everybody can afford 1672. So everybody wants that house, and it's at the fringe of what you can still get a nice house for. So these houses might be harder to find. If you roll it back even more and say, well, I'm going to look at houses in the low 2s, these are houses a lot of people are going to overlook because in reality, if it's priced that low, it's probably not a nice house. As long as it's not structural and it's physically okay to be in, you can fix up the cosmetic and at least avoid this or avoid this, right? So what does that look like? Well, now you have a mortgage payment of about $1,200 with tax and insurance. You got to come up with about 20 grand with 10% down, and you can catch that 4.8 interest rate in 30 years. You don't have a payment. Even if you go to 20 years, you're still at $1,500. 20 years from now, you have $0 a month for your payment. And that might be a good selection. 30 years is $1,280. If you go to 20 years, it's only $260 more to be done in 20 years. That saves 10 years off your mortgage. Take whatever age you are now, add 20, and imagine yourself in that place having zero monthly payment for rent or mortgage. Now, the house that you're going to find at 225 might be a sled beat up house, but you can fix some of those things. Paint, carpet, things you can do yourself are very cheap. The worst case scenario is you have a roof over your head, that the payment's not going to change. Your payment of $1,533 for a mortgage for 20 years is not going to change. It's going to stay fixed forever until it goes to zero. So these are reasons why this fear, life without retirement savings, or graying, retiring on the streets, is a real possibility for millions of people if you do not have retirement, which it's tough to catch up on that, or you don't have a home that you can fall back on. And median incomes at $70,000 are not going to get you into a house at $500 or $550 3 or 4 years from now if the home prices keep going the way that they did.